Hello students, so welcome to this particular session number 4. So students, this particular session we will have now a very advanced discussion on the general charge of the PGBP. In fact, I can tell you that now the discussion which we are going to have is going to literally unfold the entire PGBP as a concept. In the last lecture so far in the session 3, what we have considered was certain very important areas. So if I have to take or I have to tell you the areas that we have covered in our session number 3 was about the cases of the profit and gains, what exactly that particular profit and gains imply. I have given you a comparison between the 4 heads of income wherein it's like 2 versus 2. You'll say, what is this 2 versus 2? So 2 is your PGBP and IFOS, and second is your, in the second side you have the house property and capital gains. Now so far as PGBP and IFOS is concerned, the income which is computed is heavily based upon what? It is heavily based upon the net profit as per the books of accounts, which implies that we have to take the commercial accounting principle profit, the profit which is determined as per the commercial accounting principle as our base for these particular heads of income. And on that particular profit, what we do is the statutory adjustment that we have seen for PGBP. These adjustments that we are talking about is from section 28 to section 43D. Since I told to all of you that the 70% of this final PGBP is based on the commercial accounting principle, which also includes the accounting conventions and the standards. Therefore, in order to ensure that there is a less of revenue leakage and less of litigation, that income tax law now has its own standards of computation of income, which is all known as ICDS. And we have concluded in the last lecture that if there is any conflict between the accounting standard and the ICDS, it is the later, that is the ICDS, that will prevail over the accounting standard. So this is what was the aspect of our discussion, and accordingly the final profit and gains which is chargeable in under the head PGBP is the profit as per the commercial accounting principle. That profit as per the commercial accounting principle will be made subject to section 28 to 43D, and also subject to the ICDS from 1 to 10, which finally will give you the chargeable profit under the head PGBP. One particular point, students, which I have discussed with all of you in this regard was that before we start with the profit under the head, before we start with the computation of the income under the head PGBP, first and the foremost part in the total income computation is the classification of the income. And we have seen in our last lecture the two formats which I have given to all of you as to how your examination question will be based upon. You have the entire P&L, and then thereafter the additional information. That is the first format which I have given you, which is not what you're going to get in the examination. Your examination would be like, they will give it to you the net profit directly of that particular entity after the debit and credit of the following, meaning thereby they are going to give you the extracts. So extracts will be given of those relevant debit and the relevant credit, and in that extract I told to all of you that you are supposed to take into account first those particular amount or the items which are chargeable in the other heads of income. Those particular amounts or the items which are chargeable in the other heads of income, that will be our step number 1, so that you thereafter determine the net profit as per the books for business. Once you arrive at the net profit as per the books for business, you have to check out whether that net profit is it as per the commercial accounting principle or not. And therefore, when we talk about this, that whether the net profit is it as per the commercial accounting principle, essentially what we are suggesting in this case is whether the item which is debited or credited is either a trading item or an item which is incurred or which arises in the normal course of business. Incurred or arises in the normal course of business. So just keep those particular perspective also in mind. We have seen certain example yesterday. Primarily the last lecture that we have did was about this particular example of the stock loss which is there because of, say, some event. Fire was the example which we have given, and that was being debited. And if it was being debited, whether that deduction will that be allowed? And the answer is yes. But at the same point of time, if on account of the same fire, if there is a loss of plant and machinery, then you cannot write off the loss of plant and machinery in your profit and loss account. And if you have written off, then your profit is not as per the commercial accounting principle. And that is the reason why when you added back that capital loss, the reason that we have said was because it is not as per the commercial accounting principle. So students, and also some more example that we have shared was about the opening stock, closing stock, undervaluation, overvaluation. So even those sort of rectification was required, because you have to arrive at the profit as per the commercial accounting principle, because only on that you are going to further do your statutory adjustment or the adjustment relating to ICDS. So first step in the total income computation, classification of income. You then get your net profit as per the books for business. Check out if that net profit is it as per the commercial accounting principle. If not, then do those relevant adjustment. Do those relevant adjustment. After this, students, I have also told you, like if you remember yesterday, the earlier class, what we did was about the capital receipt on liquidation, on some cancellation of the contract, cancellation of a business contract. If there is a capital receipt, generally as per the commercial accounting principle, these amount should not be charged, isn't it? Because they are neither this nor that, but because of the specific charge, what was section number? What was that section number? The section number was 28(2)(e). So because of those specific charge under a particular section, that those amount are now being brought to tax. So this is also a very critical part, that is there any specific charge of a capital receipt which otherwise could not be charged under the 28(1), which is the general charge. So if there is any specific charge, please bring that specific charge to tax. So students, even that is what we have considered. So then finally our entire objective was to thereafter further do the computation as per the statutory adjustment of the head PGBP, and the second one was the ICDS. One ICDS which we have all referred in the class was ICDS number 4. In the ICDS number 4, in fact, the first particular part which you have learned was that the items which are covered for the revenue recognition in ICDS number 4 are essentially to do with what? To do with PGBP and IFOS. We have seen that there is no item which is chargeable under the head salary or under the head house property, or for that matter even capital gains. Reason was clear, that the computation item for the head capital gains or for the head house property is completely coded in the respective head itself. Completely coded in the respective head itself. So we have in those two heads everything which is required for the purpose of the computation of that income. Everything. which is required for the purpose of the computation of the income, as far as those two heads are concerned. So students, in this context, those revenue recognition ICDS 4 that we have referred, first was for goods, another was for service. As far as the goods are concerned, absolutely nothing. Whichever was the discussion that we had for the goods, as per AS 9, the same principle of recognizing the revenue is captured even in ICDS 4. Same principle. But when it came down to services, and we have seen that if the service contract duration is for more than 90 days, then now as per ICDS 4, we have shared already that what is only to be considered is the percentage of completion method. You will not go with the completed contract method. Students, one point I'll just bring to your notice and to bring to your attention. Please be attentive on this particular part. When we talk about income tax law, primarily what we are supposed to look into it is whether the amount is chargeable to tax or not. For that matter, we have seen about section number 4, the total income concept, part 1 and part 2. Remember the definition of total income? Part 1, revenue receipt plus a specified capital receipt, and second one was that this revenue receipt and the specified capital receipt should also form part of the scope of the charge, which is in section number 5. That will give you the qualifying amount. So this part, students, talks about whether an amount is chargeable or not. This is what it has reflected upon. Once we are settled with those particular items, which finally we are going to say that yes, these items are chargeable, thereafter we go to the computation part. And while we do the computation part, it is important, it is the first question to be targeted is when it is chargeable. That is the concept of the previous year. If you remember, students, that case law that we have discussed, Henkel Spick India Limited, I think that was the very first class wherein this case law was being discussed. The interest on the share application money which got accrued in that particular trust account. We have said that the year in which the allotment of that shares has been made, only in that year that the company could be made charge to tax. Only that year. So the year of chargeability, when the income would be chargeable, that is the recognition part. So when I am talking about the recognition, this word, whenever I am using it in our discussion, whenever we use the word recognition, what does it mean? When it would be chargeable. So even that ICDS 4 technically is answering that question when. Please be careful. When we discuss the concept, whether it is chargeable or not, for that point number 1 and 2. Whether it is chargeable or not, for that point number 1 and 2. What is that point number 1 and 2? The revenue receipt plus the specified capital receipt. 2 is that that particular amount should also fall within the scope of section 5. That was what primarily the 1 and 2 and which will give rise to, finally it will give rise to the qualifying amount. But once that is settled, the next question is when it would be chargeable. That's a recognition part. So Henkel Spick India ICDS 4 starts from that particular stage when it is chargeable. Okay, so let me ask you the question on this discussion. Let me ask you that question, that liquidated damage in our yesterday's example, wherein the buyer got the damage from the supplier of the buyer, received the liquidated damages from the supplier of that particular plant and machinery. So to that discussion, students, what we have said that the chargeability will not be attracted. The reason was it is a capital receipt, therefore it is not attracted. So we are talking about point number 1. revenue receipt and the capital receipt. So here the question about capital receipt came. Therefore, we were discussing that since it is a capital receipt, it is not taxable. But to ensure that it is brought to charge to tax, that we now have a specific chargeability under the first, the definition of income under section 2 clause 24, and second under section 28 2e, where it is specifically provided that these amount would be charged to tax. So we were talking about, or we were discussing about that particular point about it is chargeability, and we have said that because of certain specific provision the amount is chargeable. Because of some specific provision the amount is chargeable. That is what we have settled. After that, as I told you, the next particular part is, when you have settled down with the amount, the next part is recognition. When it would be charged is something that is a recognition principle. I am putting this particular statements consistently in your mind because it is so important that you should also know when you write what you are writing. Are you writing the answer based on about the whether the amount is chargeable or not? That particular is that the direction of your answer, or you are trying to talk about when the chargeability will materialize, when the chargeability would be materializing. So be careful, students. Identify, read the question carefully, try to pick up those particular important aspect, and thereafter decide exactly where the answer should be directed upon. This is what you need to always inculcate upon. We will give those notes also towards primarily. I'll give you those some brief notes, but I want to give you that particular notes, whatever the discussion that I had towards the end, so that we can first consolidate all our pointers and then step by step we'll do the note making of this particular exercise. Now coming to this particular issue, students, which we have left out yesterday, this particular part, the B first bullet point. Students, do one thing towards your end of the end of the topic, take that detail note side, come to the detail notes. There you will write one case study. Please write the case study.